Income and growth stocks are two primary categories of stocks that investors consider when building their portfolios. Understanding the difference between these two types of stocks is crucial for making informed investment decisions. First, let's start with income stocks. Income stocks are shares in companies that pay out a significant portion of their profits to shareholders in the form of dividends. These companies typically have a history of stable earnings and a strong track record of paying consistent dividends. Investors who prioritize regular income often prefer income stocks. Examples of income stocks include real estate investment trusts, utility companies, and established corporations with a history of paying consistent dividends. On the other hand, growth stocks are shares in companies that are expected to experience high levels of growth in the future. These companies often reinvest their profits into the business to fuel expansion, rather than paying out dividends. Growth stocks can be more volatile, but they offer the potential for higher returns over the long term. Examples of growth stocks include technology startups, biotech companies, and emerging players in rapidly expanding industries. When deciding between income and growth stocks, it's essential to consider your investment goals and risk tolerance. If you prioritize regular income and are willing to accept relatively lower returns, income stocks may be the better choice. However, if you're willing to take on more risk in pursuit of higher returns, growth stocks may be more suitable. To illustrate the difference, consider a real-world example. Suppose you invest in a utility company that pays a 4% annual dividend, versus a tech startup that doesn't pay dividends but has the potential to double in value over the next few years. The utility company would provide a steady stream of income, while the tech startup offers the potential for significant capital appreciation. In terms of best practices, it's often a good idea to diversify your portfolio by including a mix of both income and growth stocks. This can help you balance your risk and potential returns, and ensure that you're well positioned to achieve your investment goals. Additionally, it's essential to do your research and carefully evaluate the financial health and prospects of any company before investing in its stock. Ultimately, the choice between income and growth stocks depends on your individual circumstances and investment objectives. By understanding the characteristics of each type of stock and considering your own needs and risk tolerance, you can make informed decisions and build a portfolio that meets your goals.